Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is AT&T Incorporated, ticker T. Over the next 5 minutes I will discuss both the valuation of this company and its business quality. Let's dive right on in. So AT&T is in the diversified telecommunication services They provide telecommunications, media, technology services. They provide stuff like cell phone plans, fiber plans, and cell service. I believe they also have computing, various things, cricket, AT&T, prepaid fiber. So they're providing internet service, phone service to people primarily in the United States and in Latin America. So one of the things that's really interesting and attractive is you see this beta number 0.64. That means it's relatively lower volatility you would expect in the stock. Suggests maybe it's lower volatility in the business. And so this company is known as a dividend champion. They're known for their dividends and paying a large dividend to shareholders. That tends to signal a relatively more attractive company in terms of quality. So let's see what we see on the numbers. Well, the numbers show us that in 2008 they lost money, and in 2020 they lost money. So 2 out of the last 20 years they've lost money. My typical minimum that I want to see is only one time in the last 20 years have they lost money, but we can be forgiving about 2008, and then 2020 was also a recession. So basically what this tells me is that during recessions you might expect AT&T to lose money. The other thing is I see this earnings relatively cyclical. You're not having any sort of stability here. You get up to 11%, down to 2%, up to 11% again, down to 3%, up to 11%, down to net losses in 2020. So this is not a stable return on invested capital, and I'm not impressed by this numbers. I was expecting it to be a little bit better in terms of quality based on the numbers. In addition, you can see the return on equity is relatively low. This is a utility company, basically. They're providing phone service and internet service. There is going to be substantial capital expenditures, and you're seeing the returns on that capital are relatively low. However, the big redeeming factor is you have a very attractive valuation with a PE of 8. You're also getting the company for a price to book of 0.7, so you're paying less than what they've spent on building up the company. That can be an attractive position to be in. Now, what we see is that revenue has grown at 2.9% while assets have grown at 7.4% over the last 10 years. This would explain why you've seen a relatively drop in recent years in their return on invested capital. If assets grow faster than earnings, or assets grow faster than revenue, you're going to see a reduced return on your capital during that period of time. Now, earnings have spiked into a 15% CAGR over time. I'm assuming that's going to be due in part due to buybacks, in part due to some sort of changes in the structure that way. But we'll have to dig on a little further. If you're enjoying the video so far, hit that like button. Please subscribe to the channel and ring the bell in order to get notifications as I upload new videos. One of the things you see here is they've paid a steady dividend over across the last 10 years, and it's grown about 1 to 2% over time. That means their true growth rate is about that revenue growth rate, 2 to 3%. If we go to the income statement, we look at the gross profit. Gross profit has been relatively stable and grown over time with a decrease in 2020 and 2021, presumably due to the pandemic, but it would require some further research. Operating profit doing well. Again, they're profitable across this entire period. Net income doing well, although they did lose money again in 2020. Why is that? You see a big non-cash, non-operating income charge of negative 20 million. So this loss is a non-operating asset. It might be a write-down. It would require some further effort there. Now, the big red flag that I see that I do not like to see is the shares outstanding have grown over time, and they grow significantly. It looks like a 30% increase, maybe a 20% increase in shares outstanding over the course of a 10-year period. You're being diluted about 2% a year over that time. They're having to do that in order to fund their growth. If you're going to grow like this and have low returns on capital and still pay a large dividend, then you're not going to be able to do that without dilution. In fact, when I look at this, it's really interesting. In 2012, they paid EPS of 125, but they paid a higher dividend. So how many years did they pay a dividend higher than their earnings? We have 1, 2 in 2014, let's see, 3 in 2019, 4 in 2020. So 4 out of the last 10 years, they've paid a dividend higher than the earnings for that year. That's not a really good sustainable practice, but it explains partly why they're diluting shareholders over time. Their assets have grown massively. You have $270 billion in assets in 2011 to $551 billion in assets now. So you've basically doubled your assets over the course of the 10-year period, which is very significant. You've also had to do that with taking on a lot of debt. You've gone from $61 billion in debt to $152 billion in debt. This is massive growth in assets, and it's partly explaining why you have those lower returns on your assets over time. When we look on cash flow, now remember, one of these years you had negative net income, but you had positive cash flow from operations every year. That's a very positive sign, and it somewhat offsets what we saw before. And so I am excited about that fact. However, you can see a continued massive amount of property, plant, and equipment spending every year. Basically, 50% of your cash from operations is going back into being reinvested into additional capital. You're seeing large investments in acquisitions. So you're using a lot of cash in this business. This business is very cash flow intensive. So what do I think about the company? Although you're cheap for a reason. You're cheap because you have low revenue growth. You're cheap because you can't self-fund your growth due to the low return on equity and the low return on invested capital. That return on invested capital of 5% means if you want to grow faster than 5%, you're going to have to take on debt and you're going to have to issue equity. Well, they've been growing their assets faster than their return on invested capital, so you're going to continue to see deteriorations in this business. They're earning a low return based upon that, and they're investing a ton of money in this business. Once you get over $500 billion in assets, you're talking about a lot of assets. So although investors like this company for their dividend, you shouldn't expect much more from the company than their dividend. So to me, AT&T is both cheap and not a high-quality company in the way that I think about it. They aren't stable in their return on invested capital. I am concerned about that. I'm concerned about the fact that they've managed to lose money in 2 of the last 20 years, and they're not receiving the returns that would justify the massive amounts of investor capital that they are using. So for me, AT&T is a pass. I would like higher growth. I would like more stable return on invested capital. And I don't even think the cheap valuation is able to be justified for a buy because they're not having the returns that you need to be a long-term shareholder. So for me, AT&T is a pass. If you like this video, hit the like button. Please subscribe and hit that notification bell so you can get notifications as I upload new videos. We are working through every company in the S&P 500. Until next time, stop paying fees, start building wealth.